continue on because the March contract was the near-month contract, but trading on that ceased as of the end of January. So the April contract is the more relevant one. And what we see, several things. One is that between those 2 Mondays, the percentage change in price was a drop of 9%, all right? So part of what I'm going to get at here is what must the market have thought was going to be the quantity impact of this demand shock that would lead them to change price by 9% with expectations of what the balance in the market may be in March or April or the ensuing quarter. But I also think it's interesting to note, because again, most people don't really understand how the settlement price happens in the futures markets. I think it's interesting to note that, I guess I can use this, is that the settlement price is the gray one in here, and it is with this one exception, which is I guess that's the 5th of February? Yeah. The settlement price was actually very close to the low for the day. Now, the settlement price in these markets is actually determined as a volume-weighted average of the trading activity that happens in the last 2 minutes of the day. And that's how that price gets determined. So at the end of the day, all of the information that was flowing through the system happens, and what we're seeing there is that by the end of the day, the market was sort of resolving on a lower end of the high and low of the day. Okay. The role of the various players that are in the market, and part of what I'm going to point out here is there are very useful things you can do with the data that's called the commitment of traders data, which ends up being a lot of what ends up being published about this in the media is, frankly, in my view, completely miscast, misinformation, and doesn't really have much relevance to what the various media players are suggesting it can do. But both the ICE is the Intercontinental Exchange in London, which is where Brent is traded. We also have the New York Mercantile Exchange in the U.S., where the light sweet crude oil from the U.S. is traded. And there, the Commitment of Traders report, actually the Commitment of Traders report concept and reporting all originated in the U.S., and then the ICE began producing its own comparable set of reports later on. But you have these 5 categories. You've got producers and merchants who are considered to be commercials and they're hedgers. You have swap dealers who are considered to be commercials and hedgers. Managed money, which are non-commercials and speculators. Managed money is a thing that I'll show you a graph in just a moment. Managed money is the one that the media likes throwing out there all the time, because buried inside of managed money are hedge funds, and everybody hates hedge funds. They're the sort of the whipping boy of speculators in the market, and certainly everything they do is bad for us, so that's what we hear about. Then you have other reporters who are non-commercials and speculators, and then non-reporters are most likely non-commercials, but since they're non-reporters, we really don't know who they are. And they're non-reporters because you're only required to report on a daily basis what your open positions are if you hold more than 350 contracts open at the end of the day. So if you're smaller than that, you don't have to report because it's seen as being an excessive burden and cost to you. But those people are most likely going to be speculators. I have a good colleague, my good friend Imad Musa, has argued more than once that he believes that I am the most strident supporter of speculators that he's ever known. The speculators are very, very important to the operation of these markets, and these markets would not be able to provide the kind of risk mitigation opportunity that they give, and we would also have much higher cost of risk mitigation without their participation. What they then report is the open positions that are longs, shorts, and spreads. Spreads need an explanation. Long and short should be fairly straightforward. Long is where you're basically going in and you're taking the long position. You're effectively buying oil. Shorts, you're taking the short position. You're effectively selling oil. Spreads, and the longs and shorts are typically referred to as outright activities. I go in, I go long, and that's all I do. I go in, I go short, and that's all I do. But a spread, as reported here, are referred to as calendar spreads. And it's important to understand the role of spreads because spreads are close to the single largest trading component that happens in the futures markets now for crude oil and for natural gas as well. Spreads, the calendar spread is basically, I would go long on one maturity and short on a different maturity, but in the same commodity. And since I'm in different maturities, they don't cancel one another out, but they also, those two activities have no ability to move the market either up or down. And you take a position like that because what you're expecting is a change in the slope of the forward curve. And you make money if the forward curve slope changes. You make no money if it either rises up level or drops level. Because if it rises, the long makes money and the short loses. If it falls, the long loses and the short makes money. So they cancel each other out. So these are based on the change in the slope. Now this is, I'm actually challenging some people at CapStark in some of the reporting that they're doing because they've simply said, well, if Bloomberg reports this, so should we. If OPEC reports this, so should we. If IEA reports this, so should we. And it's managed money net longs. So the managed money folks we'll see in a moment. Well, actually, I don't have that table laid out that way. Managed money will have long positions, short positions, and spread positions. But as I said, the spread positions are basically offsetting. One's long, one's short. They just happen to be in different maturities. Okay, so the net long is, with managed money, is because they're speculators. If the net long, somehow they're responsible for driving prices up, which is also not true. But the thing that I think is most important to point out here, and I think the flaw in the way that they use is, especially with respect to Brent, is managed money is a relatively small player in this marketplace relative to everybody else in these net longs. The average net long over all of 2019 and so far into 2020 is under 13% of the contracts that are available. And in the time frame that I'm looking at, the biggest movements that happened in the marketplace came from the commercial side of producers and merchants, and including the big increase in the short side. And since prices have fallen this time, it's the increase in shorts that would have the appearance of being responsible for pushing prices down. And since I've only got 5 minutes, I'm going to go through this very quickly, but you can see the gray part in the middle is the spread trades. And that's nearly 30% of all of the trading activity. But more importantly, and part of the reason why I emphasize that speculators make this whole thing work, is if you look at, this is just one Tuesday to another Tuesday because that's the way that it's reported. If you look on the short column and you look at the blue at the bottom and the little orange above that, that would, and you note that that's always larger than their corresponding role in longs. It means that hedgers are always, in this marketplace, always net short. Since they're net short, if they want to be able to mitigate their risk, someone else has to come in on the long side. Those are speculators. The speculators come in and fill that gap, all right? And then beyond just filling that gap, speculators provide liquidity in the market, which makes it possible for traders to easily get in and out of contracts to adjust to the world around them. All right, so if I can't blame what happened on prices to speculators, where else can we go and what can we do? And basically, I'm going to move now to the model that Smith developed, and there's a reference for you there, 2009. His elasticity model is basically, he gave a very nice, eloquent development of this. I'm being less eloquent, but I wanted to do the graphical explanation as well, because some people are very often used to using elasticities with only the elasticity of supply or only the elasticity of demand involved. Okay, and the reason for having both of them in there is because with the demand shift that happens here, at the initial equilibrium price, I immediately have an excess supply. And to move from that excess supply to the new equilibrium, I'm effectively traveling down both the supply and the demand curve, so the elasticities of both of those come into play. I invert what Jim had there so that I can take an observation of the percentage change in price with some inputs for the short-run elasticities to tell me what the market must have thought was happening with quantity to resolve at that point. All right, so the elasticities that Jim resolved on after doing basically a meta-study of a lot of work that were done both for long and short-term elasticities are 0.04 for supply, minus 0.05 for demand. The price, percentage change in price that we already saw was the 9%. And if we're assuming, which is the basic assumption these days, is 100 million barrels per day for oil production and consumption, work through the model, and it basically suggests that the 9% price, percentage change in price that we observed must have underlying that an expectation of a 810,000 barrel per day reduction from this demand shock, all right? I don't have enough time because I've got less than a minute now. The one range that I did was to say, well, in the really short run, there is basically perfectly inelastic supply. That oil was on a ship. It was on its way to China already. So the implications of that, as it turns out, though, is that you need to expect a smaller amount of demand reduction to get the same percentage change in price. And this would turn out to be 450,000 barrels per day. And I'm going to go ahead and jump to the bottom, and these will be available. The point here is that the 810,000 barrels per day amounts to 6% of the daily consumption on average for China. And if you're looking at a reduction, expecting a reduction of 6% of the consumption, what must you be expecting the decrease in GDP to be that would lead to that? If I have an income elasticity of 1, then that would be a reduction of 6% on an annualized basis. And if you bring that down to a month or a quarter, it's basically suggesting that the market thinks or thought that we are going to have flat economic demand, economic growth in China for March, April, and maybe into the second quarter. And I will leave the conclusion setting up there so you can look at them as we move to questions. Thank you.
Thank you very much, Ron. Thank you, Jeff. Thank you, Janet. We'll use the rest of the time for a Q&A session. I'm sure the speakers will be more than happy to reply to any questions you might ask. So we'll pass these microphones around.
Okay, thank you. I would like to ask a question to Jeff Hardy. I wonder why is the penetration for the renewable energy in the UK is less than in the New Zealand? Yeah. Thank you.
So simply put, we have traditionally come out of being a coal economy. So someone can help me out with figures, but it's not that long ago. It was about 80-ish%, thank you, Richard, of the economy down to 7%. It was gas that came in because of our natural resources in the UK through the Dash for Gas. And then it's been targets driven by climate, driven by European directives that have started to make an impact on renewables. So progress looks slow compared to other economies, but the rate of penetration of renewable electricity into the system has been phenomenal over the past decade or so. And if you continue that trend, from that slide, we're going to be putting around 4 gigawatts of renewables into the system every year for the next 30 years, give or take. So it's taken us a while because of the kind of the nature of the economy, the nature of our indigenous resources, but my goodness, the pace now, it's phenomenal.
Thank you.
Richard Green, Imperial College Business School. Question in a sense for Janet and for Jeff, and I suppose declaration, Jeff and I have written together on various things. Jeff's survey that said a significant number of consumers were thinking they might like to get into peer-to-peer energy trading, which I guess would be a major change in their energy consumption practices. Do you feel, from that perspective, do you think it's something that's likely to happen once it actually gets to the nitty-gritty, rather than just, oh, this sounds cool, I'll say yes to it? Would it be, or have there been other examples when the practices have changed that much?
Yeah. We're starting to see business models emerging that support things like peer-to-peer trading, and one I'd really like to highlight here actually is the concept of a local energy market. So there's an organisation, a business here in New Zealand called EMH Trade, and they have the New Zealand's first local energy market up and running with about 60 household participants in a settlement just north of Dunedin, and that's been operating for maybe 18 months and is still going strong. And so this is where people who have solar sell it to their neighbours, essentially, if they've got a surplus. So they're selling it for more than they would sell if they sold on back into the grid, and their neighbours are purchasing it for less than they would buy it if they bought it off the grid. So essentially there's a net positive local benefit. Obviously there are players further up the food chain who are not getting those dollars, who may not be so happy about it, but the benefit is definitely flowing locally, and there's a school who's also part of that system. And there is a lot of interest in this kind of, I guess, localisation of energy, it's partly driven, and we've done quite a lot of work looking at what is motivating people to think about energy differently. And certainly within New Zealand, some of these changes are partly driven by economic aspirations, but they're also partly driven by a sense of wanting a level of resilience, of connection to their neighbours, of being able to share. I call it energy as a vegetable. If you've got too many cabbages in your garden, you would share them, and you wouldn't feel particularly aggrieved that you weren't getting a lot of money for them. So I think there's some really interesting things happening here where peer-to-peer trading, either locally or more distantly, offers people a whole lot of different qualities than they are used to, but ones that they are aspiring to. And when I've done a bit of a survey of some of the business models that are emerging at the moment I guess, the retail and aggregation end of things within New Zealand. And they typically are offering a bunch of qualities around localism, around sharing, around sort of green, renewable, smart. All of those kind of qualities seem to be attractive to a new breed of what are traditionally called consumers, but aren't safely called consumers any longer because they also produce, store and engage.
I'd love to see that survey at some point as well. That sounds right up my street. So in the UK, there's it's quite nascent on peer-to-peer energy. There is some really good modelling work going on in that Energy Revolution Research Consortium that's looking at both microgrids and peer-to-peer markets and thinking about the outcomes. So peer-to-peer can mean many things in this context. It could just be an entire community of selfish optimizers, trying to maximize their own benefits and stiff their neighbors, putting it crudely. But within all of this, there has to be kind of some wider UK outcomes embedded within that, whether it's to kind of like minimize the size of the electricity system you need to build in order to accommodate all of the renewables and all of the new demands, or whether it's a carbon. So I'd love that story about the carbon because I have PV and battery at home. Over winter, of course, there's no sun in the UK. My energy consumption's gone up because my battery's in arbitrage mode. So I have half-hourly price signals, and I'm actually buying low and selling high on the battery, and I've probably put about 40% consumption on over winter, which makes sense for me because I'm optimizing, or rather the AI in my battery is optimizing against that. Obviously, that won't hold when everyone else comes in and cannibalizes that price. So I think that the key with peer-to-peer for me is how will it deliver on the wider system outcomes, and how will different peer-to-peer markets link together so that the whole is something better, presumably, I think. So the system works better, the kind of like everyone's happier within that context. It doesn't have to be selfish optimization, it might be gifting energy, all of that kind of thing. So there's loads of stuff in my mind that peer-to-peer could solve, and clearly there's a community in the UK that would go for it, if you believe a survey. So it's how is it kind of like part of this bigger picture of where we're going to need to be in a net zero economy?
I'll just add one other thing here. I think looking more widely than just the idea of peer-to-peer trading, but more around adoption of things like electric vehicles, solar, battery, all of these interesting grid edge evolutions that are occurring. We tend to have this kind of language around consumer behaviour, but we forget actually that it's consumer misbehaviour that could completely disrupt the grid. And so we need to think about what might consumer misbehaviour look like, because it's completely logical for them and for each of us to make decisions on our own behalf. But we're not going to necessarily be making decisions that are in the interests of the grid as a whole. And in fact, should we be expected to? Exactly.
So, Peter Hartley, Rice University. I guess I got a question for Ron. First thing is, how does this proposed calculation of what's going to happen to China GDP compare with the recent data on that? But related to that is, implicit in your analysis is that there's no spillover, other countries won't be affected, it's only China. Initially, I think people felt this might become a worldwide thing. So that brings up the question, could you look at the dynamics of the change and also the profile of the forward curve to tell you something about market expectations of the evolution of this thing over time?
Good questions. Yes, I think looking further out the forward curve is something that I intend to do. The idea that, I mean, right now, putting all 810,000 barrels per day on China's shoulders is really sort of an extension of, this is a short term where it's going to happen, and it would take time for the spillover to actually reach on out. That's also part of the reason why I did the other range of the inelastic supply curve. But in terms of It's interesting the way you asked the question about how does it line up with data. Well, it's been such a short period of time, there is no data about how much is actually going in and going out. There are people that have claimed that they know what volumes have fallen off going in or being consumed, but I really am not familiar, and I've talked with all sorts of people at CAPSARC, and no one knows where that data could possibly be coming from. But I mean, there was a Bloomberg article last week that suggested that they had data that told them that 3 million barrels a day had come out of the market. Well, I don't know where they would find that information, and even the perfectly inelastic supply, which in some ways I think is actually in the short span we're talking about, I think is actually a pretty logical expectation that supply is on the water, it's moving. There's no way that that's coming back anytime soon, not in the next month or so. But that only leads to a demand shock of 450,000 barrels per day, and no one is talking that low. So that doesn't mean that 450 is wrong. It could easily mean that the market has misassessed, because that does happen. I mean, the first time I employed this sort of reverse of what Jim did was back in September, October, following the missile attacks on the Saudi Aramco facilities. And the media kept telling us every day, over and over and over again, that we've had 5.7 million barrels per day taken out of the market. Well, the market didn't think so, because if you took the percentage change in price that happened there and you used reasonable numbers for the elasticities, they thought it was maybe 2 million, and that disappeared within a week. The one thing about this is the market has not retrenched on this at all. I mean, the closing price today is still 2% lower than the closing price was on the 27th of January. So it's actually 11% below where it started on the 20th of January. So the market, and that's logical given the continued revelations of the expansion of the effects of the coronavirus. So there are a number of things I plan on following further with this, but and definitely looking more out the forward curve. I mean, if you do look more out the forward curve, and it's effectively what you see when you compare the 9.02% for March and the 9% for April. The whole curve basically moved that amount. So from just before the 20th of January, so I would say pre-coronavirus effect in the marketplace, the market now across the forward curve thinks that there's going to be an impact that is going to last at least for a while. There is some evidence in the data when you go and look at the trading volumes, which I didn't talk about the trading volumes here at all, in part because I wanted to do the part about the open interest, because that can actually be broken out into commercials, non-commercials. There is no data available to us that will allow us to break out trading volumes into commercials, non-commercials. So but trading volumes went up substantially from the 20th to the 27th. But that makes sense. We have a lot of uncertainty in the marketplace, so the only way we find out what the value of something is through trading. So trading happens and we resolve on a new price. But one of the things that I noted was that we went from, on the 20th, the first two contract delivery months, March and April, accounted for nearly 60% of all the trading activity on that day. And by the 27th, those two contracts only accounted for 45%. So there was more trading going on out the forward curve because there was more interest and concern about what the implications were further up the curve.
Interesting position. I come from a consumer organisation in Australia, Energy Consumers Australia, and I made the observation in the first plenary we hadn't heard much about consumers, and it was nice to hear them at the last plenary. But a couple of questions or observations, I guess. The first is to go to the important stuff that Jeff put up, which is that for the deep decarbonisation agenda and the electrification agenda, there's a whole lot of things that have to happen that aren't about the efficiency of the existing system. It's about changing actually appliances and technologies. It's the vehicles and the heating. Good to know that the numbers that say the existing replacement rates are sufficient to get you there. But it is an interesting question to come back to Janet's point about how do you bring the practices and behaviours to play, and what are the other levers apart from that could be done to accelerate that. And I don't know if I was going to ask Janet if she's actually looked at that kind of specific question, the need to change the appliances. But the second one is a question for economists in general about markets. Because we've got a lot of people talking about things like peer-to-peer markets in the distribution area. And yet, if you look at the wholesale markets, New Zealand and Australia at least explicitly have got a mandatory market. You're generating, you have to participate in one market. And there's a reason for that, which is that you've got to manage that flow across a transmission network. And what we're seeing is this sort of sense that people think they're going to have a whole lot of little markets emerging in the distribution area. And I've got a question for economists in the room generally. How sustainable is this model of little peer-to-peer clubs within the distribution system, or are we actually going to have to get to the same model, especially if we've got 60% of generation coming from the distribution network? So, general question.
Okay, there's a lot in there. Yeah. So in terms of levers, I guess as somebody who feels strongly about the notion of energy, democracy and equity, I hesitate to fully leap into the space of leveraging or controlling people who are doing things because they think it's the right thing to do for themselves or for their communities. That being said, there is huge potential for inequitable outcomes out of a wholesale uptake of grid edge change. And I'm sure you're as aware, as if you're from a consumer organisation, you'll be fully aware of the fact that the more wealthy of the community can afford to purchase things that will make their long-term costs a whole lot lower, leaving those higher costs to the less wealthy. So how to introduce mechanisms that will avoid that, I think is a really, really important question. And certainly in the New Zealand context, we have a lot of words about, at a policy level, about trying to avoid those inequities to achieve a just transition. But actually, we have not yet unpicked what those precisely might be, how big they might be, who amongst the community might be suffering these things. We can guess, but we have not actually done the empirical work to show that. And so there's a big question mark about that question. More generally, I think the question of levers, we in the energy cultures research, that was looking both at household behaviour change around efficiency, and also in the transport sector, changes within the transport sector to more efficient and renewable forms of transport. The approach we took there was actually to start to try and understand the energy cultures of the different users, or the different people who were using these or delivering these outcomes. So that meant looking at households, it meant looking at businesses, it meant in some instances is looking at people like delivery truck companies and so on, and looking at what are the particular energy cultures that are locking them into ways of behaving that may well have poor carbon outcomes. And then say, okay, once we look at that, what is it, how how habitually are they built into those energy cultures, but also externally to that. If you remember, the diagram says, okay, there are some things that are locking them in and some things that might be delivering change. In each instance, there will be particular, you could call them levers, that you can think about what's going to work in this instance to try and drive change. And so, for example, we looked at electric vehicles. We could tell from our survey work that New Zealanders had a really high propensity to want to buy electric vehicles. So what was specifically locking them into maintaining their existing cars? And what about the energy cultures was actually aligned with the adoption of EVs? So I won't go into the detail there, but that's the kind of approach we took. So it wasn't just looking blanket saying, here's a lever that will pull, but let's be much more specific about which groups we're trying to target and what might encourage them to change in a positive way. So going beyond a nudge and being much more carefully designing policy levers out of that.
Thank you. So I'll add only quickly on top of that. So I think I'll leave the room to solve the market question. But just to say that what we sort of expect to happen, broadly speaking, in the UK, according to the scenario, is exactly what discussed. So there's going to be a lot of action at the local level, both in terms of generation and new sources of electricity demand, heating electric vehicles. There will be an awful lot of variable output, high capex, low operating cost renewables on the system, so the marginal cost of electricity could be incredibly low and negative when there's too much on the system. Therefore, it's really, in the UK, with our grid infrastructure, a question of moving it around to make sure that really demand is following supply and that you can get it from A to B. So you're not having to overinvest in new generation closer to certain places, all of that kind of stuff. So there's lots of things. So there's the big question in the UK about whether or not you're paying for capacity and constraints rather than the cost of energy in there. The second bit of all of this, so what I say is any market structure is probably going to be dealing with that, not necessarily the kind of like the price of energy so much, the commodity, so to speak. You know, so in my instance, as I just described, it makes sense for me to consume more, particularly when it's low carbon, because that is certainly fixed with the price at the moment. The thing that I think is going to be most important in all of this is data. So consumers are a myriad of, have a myriad of values and preferences. And energy is not that important to most consumers. 50% of UK consumers have never ever switched since privatisation. There's a churn of about 20% of active switches at the top of the market. It's not dissimilar in other places. So consumers are going to need some help through this low carbon journey. It's going to mean more complexity on pricing. It's going to mean new kit coming in. And different consumers are going to want different journeys through that. And they're going to want different sorts of help. So some consumers are going to want some party to come in and take away all of the complexity and install the kit and help them through that and protect them from prices. Others will want to have full fat access to all of these exciting new markets and do all the stuff themselves. This means you can't have a market where there are, in the UK we've got 6 consumer segments in the energy market. As an example, Amazon has got 150,000 consumer archetypes. That's how it works. That's how it knows that you're going to buy that thing that you didn't know you were going to buy, so it's in a store near you, so it can be with you in an hour. That's the kind of like the difference that data enables. So this is psychographic data, energy data, all of that really important stuff. So what that means, I think, is there's going to be an explosion of business models, approaches. They might be community focused, they might be peer-to-peer focused, they might be Amazon running your life. All of that stuff could be in there, which makes the job of a regulator a bit different in the future, because you can't go around pulling levers and saying, don't do that, you must do this. It becomes, the regulator has to become better at data than any of the market participants and follow trends and what's kind of like broader things and what should be happening in the market in response to those trends, and then stamp down with a commensurately large hammer on anything that's wrong. So it's almost impossible to know because there's so much uncertainty in all of this. And this is why I find it the most exciting area to work in, because absolutely no one's right about it.
Can I just add something on data? Yeah. When you look at the traditional, certainly for New Zealand and probably elsewhere, the traditional model we've had is a supply-led system. And because of that, we know to a kilowatt hour, to a watt, the exact energy flows. We know what the wind is doing in every turbine. We know what the market's doing in incredibly infinitesimal detail. Once we get to the consumer, we know nothing. They're a complete black box. If you're a retailer who happens to have smart meters, you've got data about them. But apart from that, the data about the consumer side is so unavailable that there's a huge difficulty for people to innovate in that space because they just do not know what is happening at the demand side. In part of our work, we created a data set for 40 households of 2 years' worth of appliance level data. That is the best data set New Zealand has ever had.
Can I just make one clarification? When I was talking, there's two points here. One was the point about market design as in local levers. And the lever question is very much about the carbon transition, which is you've got to get those devices changed. And I'm really intrigued by that vehicle one because there was a presentation earlier in the week by Lee White on some research from America which showed a revealed preference of consumers saying, total cost of ownership of a big vehicle doesn't bother me at all. It's all these other factors. And I'm sitting there thinking, I cannot believe that's a correct outcome. Total cost of ownership used to be a barrier to buying an electric vehicle.
All right, so just briefly on it. So, all right, UK has just, in theory, committed to phasing out internal combustion engines. So you can't buy a new one by 2035. So that's a very strong signal to the market. But data on satisfaction with electric vehicles is immense in the UK. People love them, absolutely love them. It's kind of like you get in them and you go, wee, is the general gist with them. So there's no problem with the take-up, I don't think, in the UK. I think that will go exponentially. You've got early adopters now. It will go exponential. The issue that we're going to have and the big bun fight that's going to come is overcharging infrastructure. Not because I think there's a real problem with range anxiety in the UK. It's just working through what the right strategy is going to be so that you can access reasonably, with great interoperability across the whole structure, charging in the UK. And that's where we're starting to legislate and so forth, but that's going to be the slower bit because there's a big bun fight between the network companies and electric vehicle charging infrastructure operators and developers at the moment, where they're basically saying, so BP came out yesterday and started complaining at the UK, at the distribution network operators, that they're slowing them down, which means that someone wants someone to socialise something in there at some point, I would imagine. That's really what it's getting at.
So thank you very much. Thank you, speakers, and also for the audience for the interaction that we had this late morning over here. Let's give a big round of applause to our speakers. And before concluding our conference, our president, Yukari Yamashita, wants to give us a few words.
Well, thank you very much for everyone to staying over here until the end of this very important Asia-Oceania conference. As a president, but as a Japanese, I would like to add something about the energy transition. As I said in my presentation at the plenary, earlier, plenary 1, it requires everybody to be on board. As we have discussed just now, that consumers should be there also. The consumer's behavior change is very important, but first we have to assure that the consumer awareness will be there. Okay, my voice is too close. So, consumers' awareness should be there. For that, we need the data. But we started our energy transition path work very much earlier than the rest of the world because of the earthquake back in 2011. But first of all, we had to involve everybody who are using electricity to get on board, to save their electricity in a hurry. But they didn't know how much they were using, at what hour, and because of what. So we had to inform them if you do this, then you can save this much energy at the peak hour of 2 o'clock, so that in 4 months' time, when the summer hit, we'll be okay. During these 2.5 days, we didn't talk about blackout, but there will be something we have to prepare if something happened and then we lose the electricity supply. We are becoming so much dependent on electricity, and then first of all, we have to prepare all the users to be informed that they are using this much electricity, this much energy at this hour, and then how they can contribute if something happened. This is called resilience. It's becoming very important for us in Japan because we are sitting on all these magmas and the volcanoes, etc. But this soon will become reality for everybody because although we didn't really talk about it as an energy economist maybe yet, but adaptation is coming. The question about adaptation. So energy transitions is to prepare for that everybody who lives on this earth, but at the same time, we have to develop the technologies. It's a combination of the behavioral change, business model change, all the players to be on board, and then the developmental technologies. This is my takeaway from this conference, that everybody is keen to transit, but we don't know yet how to do it, but we just know that we have to speed up, and then we have to be involved. And then since we have the wisdom of dealing with the data, and then make analysis, and then make announcement, and then activate the policymakers and then the industries, I hope this association will involve not only the academics, but also the industrial people and then the policymakers to make things happen in the near future. Okay, I tried to get my screen out. So I would like to thank, before I close this very important conference, I'd like to thank all of the sponsors, the Student Happy Hour and the workshop sponsor, Energy Education Trust of New Zealand, and the bronze sponsors, Transpower, Vector, and Z Energy, who contributed to the success of this conference. And moreover, I repeat that we should not forget to mention the General Conference co-chairs, Professor Sharp and Professor Poletti. Yeah, thank you very, very much. And then, of course, the Energy Center team at the University of Auckland for their wonderful and fantastic work.